What's up guys, it's your boy Robert, and in today's video I want to expose meme stocks, and not just meme stocks in general, but two particular meme stocks that have been kind of the leading figures in this meme stock phenomenon. I am going to expose them and kind of give you my reasonings why I think they are completely overvalued relative to their fundamental valuations. But before we get into this video, please be sure to like this video, comment on this video, and more importantly subscribe to the channel if you are an elite millennial seeking to be and will be the first multi-millionaire in your family. This is a channel that you want to subscribe to because I post all things business, all things finance, all things entrepreneurship, and all things crushing it. So like, comment, subscribe, and let's get right into this video. Alright guys, so the first thing that I want to do is define a meme stock, because I know there could be a number of different ways that meme stocks are being defined nowadays. So I want to go to my favorite finance website that I use for almost any questions that I have in regards to anything finance, Investopedia.com. Now Investopedia.com defines a meme stock as shares of a company that have gained a cult-like following online and through social media platforms. The article goes on to say that meme stocks did not truly emerge until the year of 2020 via the Reddit forum Wallstreetbets. Now I'm gonna be honest with you guys, I don't know too much about this Reddit forum Wallstreetbets. I'm kind of familiar with Reddit, and I do like Reddit a little bit just for like funny stuff, but definitely not for my stock tips. Now the first meme stock that we're gonna be diving into in this video is GameStop, and that's ticker symbol GME. Now I want to use this time to share my personal relationship with GameStop. As a young kid, me and my siblings would go to GameStop all the time to purchase the latest video games for PlayStation, Xbox One. I still go to GameStop sometimes nowadays to buy video games when I'm playing them, but I kind of always wondered how GameStop would rebound now that a lot of video games are being offered digitally. So you can actually buy these video games on your console directly. If you're familiar with the Xbox, they have the Xbox Game Pass where you can buy the latest video games directly from your Xbox. So I kind of always wondered what would happen with GameStop, that's a brick and mortar shop that has things like overhead utilities and all these other expenses, when people can just literally purchase their games from sitting on their couch at home. But me personally, I used to love going to GameStop. Me and my brothers would go there all the time, buy the latest video games, even stay there for 30 minutes while my mom shopped or my dad shopped at the grocery store next door. We'd be playing their little demo games. So me personally, I used to love GameStop, but now I'm sorry, I have to evaluate it from a business perspective, not just as a consumer. So let's first evaluate GameStop stock performance over the past 52 weeks. So when you look at GameStop's 52-week price performance, the stock is literally up 1,847.68%. Now this is compared to the industry that's only up 82.47%, and the S&P 500 that's literally only up 33.52%. So GameStop has literally smoked the broader market index and even its industry and price performance over the past 52 weeks. Now when you look at GameStop's 52-week trading range, the lowest point within its 52-week time frame, GameStop has traded at $12.14, and at its highest point has traded at $483. Now that's nearly a $470 difference in price over the past 52 weeks. Now the first thing I want to touch on GameStop is its quarterly earnings. So GameStop is actually set to release its quarterly earnings on December 8th of 2021. GameStop actually did release earnings a few months ago for quarter 2, and unfortunately they missed analyst expectations. So GameStop reported Q2 earnings, and they missed analyst expectations, reporting an actual adjusted earnings per share of negative 0.76 cents versus analyst expectations of negative 0.67. So they actually lost more on their earnings per share than analysts even anticipated. And it's not just that it's a negative earnings per share, but in fact GameStop has reported a negative earnings per share for the past 2 consecutive quarters, which is honestly pretty concerning considering the stock price is almost up 2,000% in the past 52 weeks. So the next thing I want to highlight about GameStop is its profitability ratios. And before we go through those numbers, I definitely want to define what profitability ratios are to you guys out there. And Investopedia defines profitability ratios as a class of financial metrics that are used to assess a business's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time using data from a specific point in time. So basically, profitability profitability ratios allow you to evaluate how profitable a company is and how well a company is able to retain its total revenue after all of its expenses are said and done. So we're going to evaluate GameStop's profitability ratios, and in particular there were 3 ratios that I picked out. Number 1, profit margin. Number 2, EBITDA margin. And number 3, return on assets, better known as ROA. Now in GameStop's most recent quarter, it reported a profit margin of negative 5.21%. Now this is compared to the industry average profit margin of 9.65%. And just to put this in perspective for you guys, the way that you figure out a company's profit margin is dividing its net income by its total sales revenue. So really you can kind of interpret that negative 5.21% as for every dollar that GameStop receives in total sales, it was able to retain negative 5 cents of that dollar, just to put that profit margin into perspective, right? Secondly, we're looking at GameStop's EBITDA margin. Now EBITDA stands for earnings before interest, taxes, and depreciation, so it's a little bit lower down on the income statement. Now GameStop has a EBITDA margin of negative 0.93 versus the industry average of 14.72. Okay, and last but not least, GameStop has a return on assets, or ROA, at negative 2.39% versus the industry average of 14.85%. Now I'm going to define ROA for you guys. So ROA gives managers, investors, and analysts an idea as to how effectively a company can take its current assets and use those assets to generate revenue. So like I said, GameStop has an ROA of negative 2.39%. That means for every dollar in value that it has of its total assets, it generates negative 2 cents of that value. Okay, just to put that in perspective. So just to give you guys those numbers again, GameStop has a negative 5.21% profit margin, a negative 0.93% trailing 12 months EBITDA margin, and a negative 2.39% return on assets for the trailing 12-month period. Now I don't know what to tell you guys, but all those negative numbers is definitely not a sign of a healthy, profitable company. All right guys, the next fundamental metrics that I want to look at in regards to GameStop is its leverage ratios. Now for those of you who are not familiar, Investopedia defines leverage ratios as one of several financial measurements that look at how much capital comes in the form of debt or assesses the ability of a company to meet its financial obligations. So leverage ratios are very important when you're evaluating a company's ability to meet its financial obligations or its debt and its liabilities. So let's look at some of GameStop's leverage ratios, okay? So the 2 leverage ratios that I chose for this video are total debt to assets and the current ratio. So total debt to asset, GameStop has a total debt to assets ratio of 32.33% versus the industry average of 54.15%. I'll be honest with you, that's honestly not too bad of a number. How you can make sense of that is for every dollar in total asset that GameStop has, it has 32 cents of that in debt. So it's safe to say that GameStop does have enough total assets. If they were to become insolvent and have to liquidate those assets, they do have enough total assets to cover their total debt. Now their current ratio is at 1.41 versus the industry average of 1.34. So the current ratio is just a formula of current assets divided by current liabilities. It's a metric used to determine that if a company had to finance its short-term liabilities, do they have enough in current assets to cover those short-term liabilities? So you can read this 1.41 number such as for every dollar in current liabilities that GameStop has, they have $1.41 in current assets. So once again, that's not that bad of a number, and it's actually higher than the industry average. So it looks like from a balance sheet perspective, GameStop is a relatively healthy company. I will give them that. Now the last metric that I want to look at for GameStop is its revenue growth over the past 5 years, and this is honestly a pretty bad number. So when you look at GameStop's revenue growth over the past 5 years, on average their revenue has declined 11.48% versus the industry average of plus 8.15%. That means over the past 5 years, on average, GameStop's revenue has fallen close close to 12% for the past 5 years. So guys, after reviewing some of GameStop's profitability ratios, reviewing some of GameStop's leverage ratios, and looking at GameStop's revenue growth over the past 5 years, along with its recent quarterly earnings report, I think it's safe to say that GameStop has some profitability issues. They've reported 2 consecutive quarters of negative earnings per share growth. Their revenue has fallen over the past 5 years. Their profit margin is below industry average. In fact, they're losing money in regards to their profit margin. They have a very low return on assets. Do your due diligence on these companies, guys, because it's easy to get caught up in the hysteria and seeing the price shoot up so dramatically, and it's easy to see that you can make a quick buck off of it. But from a long-term investing standpoint, GameStop just doesn't seem like a very profitable company, and unless they plan to change things around and really revamp their business model, I don't see things getting any better for GameStop. Now, last but not least, we have AMC, another meme stock favorite. So when we look at AMC's 52-week price performance, the stock is up 1,131.04%, and this is relative to the industry average of 40.71%. So once again, just like GameStop, AMC is absolutely crushing its industry in price performance. And when you look at AMC's 52-week trading range, it's traded between $1.91 and $72.62. So literally, AMC a year ago was darn near a penny stock, and now it hit highs of $72.62 due to this meme stock mania. And when reviewing AMC's profitability ratios, once again, we have AMC's profit margin. AMC reported in its most recent quarter a profit margin of negative 77.27%, and this is versus the industry average of 2.32%. So I mean, I guess we can give AMC a little bit of leeway considering that it was the pandemic and movie theaters were closed and people weren't able to come in and spend their money on movie tickets. But I guess we can give them a little bit of leeway there, but still a negative 77.27% profit margin, meaning that for every dollar you get in total sales, you're losing 77 cents, is still pretty bad. So AMC comes in with an EBITDA margin of negative 136.90% versus the industry average of 8%. Once again, that's a negative 136.90%. Absolutely horrendous EBITDA margin. And when you look at AMC's return on assets, their return on assets is negative 25.71% versus the industry average of 1.41%. Now, when you look at AMC's leverage ratios, they have a total debt to assets ratio of 104.29% versus the industry average of 32.31%. So once again, you can read that as for every dollar in total assets they have $1.04 in total debt. So when you compare it to the industry average, that's not a very good number. So it seems like GameStop probably has a stronger balance sheet than AMC, and it seems like AMC does have a lot of debt relative to their assets. When you look at AMC's current ratio, it comes in at 0.65 versus the industry average of 1.75. So once again, for every dollar in current liabilities that AMC has, they have 65 cents in current assets. So if they were in a position where they had to sell off some assets to cover their liabilities, they simply would not have enough. And last but not least, when you look at AMC's revenue growth over the past 5 years, their revenue has fallen negative 15.86% on average over the past 5 years relative to their industry that has grown 24.82%. And guys, I'm gonna close this video out here. I think the metrics that I provided gives us enough leeway to say that the growth that we're seeing in these two stocks is just uncalled for from a fundamental perspective, and I do not think these stocks make good long-term bets for your long-term investment portfolio. I'm gonna close this video out here because my battery is about to die on this camera, but please comment below, let me know what you guys think, and by the way, do your due diligence, do not get caught up in the hype and purchase a lemon. But that's all I got for you guys today. Your boy Ra Ray, peace.